Now, as stocks continue to pull back, investors are, of course, wondering how severe this correction is likely to be. Some analysts are staying optimistic, saying rising fund flows into equities may help to reduce further market declines.
What the liquidity story does do is it limits your downside from here. So you're not going to see a correction of 30+% in my view. You're not going to go back to a price to book of, say, 1.3 for Asia. The correction will be much more like 15%, 20 at an absolute maximum, and you may go back down to sort of 1.5, maybe 1.4 times book. But I would be very surprised if we went lower than that.
That's one view, but not everyone agrees. HSBC Asset Management says even if fund flows are bigger than expected, it's not going to save Asian stocks from a second-half correction. The reason the three-month rally has made shares simply too expensive. It adds that declines of 10 to 20% will be a good chance for long-term investors to buy into emerging market stocks. Macquarie strategist Dan McCormack again thinks investors should also think about the rotation theme by now, moving into shares that have lagged the rally.
What investors should be focused on, given the deterioration in the risk-reward trade-off, is really relative value. I think there's a lot of stocks out there that have lagged that are still quite decent value. And if you look across Asia, things like the consumer plays in Korea, for example, are still very cheap. So I think they're very good sort of catch-up plays now.